we continue the chart setup. Welcome to session 3.
Yes.
Okay, now we understand the market sentiment, the work behind the dealer. So what we look on the market is we want to see the dealer's hand giving us the second leg M, the second leg W. So to make things easier to our strategy, this strategy, a number of features and indicators are added in order for you to see things clearly. So this includes the candlestick patterns and the indicators. Let's start with the candlestick patterns. The first important thing to understand on candlestick pattern is that in the wrong market context, it has little or no meaning. So we only look on the candlestick patterns in places where we expect reversals. We expect the dealer to form an M or a W. There is where we look on the candlestick patterns. So in the right market context, places where the dealer will reverse, there is where we look for the candlestick patterns. So the candlestick patterns that are most helpful are we have the spike candles, the spinning tops, the hammer, the star, the railroad track. So this is the hammer here, the hanging man, and the doji. So these three patterns usually occur on the reversals. On places where the dealer reverse, they indicate that there's a reversal. So when you see a V and you find the hammer there, or you find a hanging man or a doji, and between them, it's a good V. A good V for you to take. And even star and morning star pattern looks like this. This one is called the evening star.
Okay.
This one is the evening star here. The morning star would appear below as a V bottom. So this candle here, this candle in between, retail traders call this candle as an indecision candle, as buyers and sellers have fought their battles, the bears, the bulls. So there is no proper decision on where the market would go. That's the indication they have. But to the market makers, this is simply extra 15 minutes for the dealer to take your money, to take pending orders there. So on forming that doji candle, I mean that candle there, the dealer usually opens and closes the spread to fetch the pending orders and the stop losses. That's the main deal there. So if you see a reversal pattern like this, we call this as a fast M, like the M which has occurred very fast. Within 45 minutes, we have an M. When you look on the 5 minutes chart, you find a good M. This is a V here, but when you look on the 5 minutes chart, you find an M. Are we clear there?
Yes.
Okay, so this is the evening star, the morning star, so you just shift it as a V bottom there. We have the railroad tracks. So the railroad tracks, a simple explanation about the railroad tracks is that on the Asian session here, the dealer would set the high of the day. Initially, this is the first high of the day. And then the dealer will do the stop hunt here. He sets another high of the day here.
Okay.
So he gives us the M pattern here. See, with an entry confirmation. But then the dealer wants to offload some people or wants to do a deep stop hunt there. So this is what he does. So the first open was this candle. Do you see this spike candle?
Yes.
This is the first open that the dealer used to trigger the stop losses, but he found that it wasn't enough. So he went on with a spike candle. He sets the new high of the day, and then he reverses with the same spike candle, the same length. So this one is called the railroad track, an RR pattern. So if you're confident enough, you enter aggressively here.
Okay.
Now, on taking entries on M's and W's, have I talked of the stop loss? I did talk of the stop loss. So we usually put the stop loss on the M's and W. This is the high of the day, right? Initially.
Yes.
This was the M here. So you take the entry here, but you measure the number of pips from this point, 23 pips from the high of the day. If it's an M, if it's a W, 23 pips from the low of the day, and you add our number of spread here.
So the 23 is the key number, either up or down.
Yes, plus the spread. So on the template there, you find the spread.
Okay.
I see the template used by data. It has the spread value on this. There's a dashboard here with many words. There's the spread there. Did you get me there?
Yes.
Okay, you'll find the spread there. So you add the spread there if it's a 2 pips spread or 4 pips, so you add there. No. Yes. Okay, this is another example of a railroad track here. The dealer went down here and reversed aggressively. But this kind of a railroad track in which he hasn't set the initial high of the day, you wait for, you don't enter aggressively, so you wait for the entry confirmation here. When the candle, okay?
So for the railroad track, it's the candle itself, not the wick. It's the two candles being the same length. It doesn't factor in if the wicks are different.
It doesn't factor the wick.
Okay.
So if the dealer doesn't set the initial high of the day like here, you just find the railroad track, you wait for the entry confirmation. When the dealer closes the candle above the catch up and the master there,
Okay.
that is where you enter your trade. Okay, we have the spike candles. Spike candle is we define it as an aggressive change in price. Usually it occurs after news announcements, which is used to trigger the stops or move the trading zone away. So direction of the spike candle is based solely upon the dealer's open volume, the net longs on the net shorts. So an example of spike candles, this is a spike candle here. This was Monday, week beginning. And the week beginning, we assume the dealer will do a stop and high. It's not an assumption, it usually occurs like that. So the dealer will do the stop and the false move high if he wants to trade low for the week, if he wants to trade short. So he would go long on the week beginning. So this was a spike candle upon news release. So this one was used to create a false move, trigger the stops, and then the dealer reversed from here. And he did trade away from this peak throughout the week. So this spike candle here was used to trigger the stops. But this spike candle here was used to shift the trading zone. So the dealer was trading low here. And as you can see, it was Friday. So the dealer was trading low to trading short. And then there was a news release. So the dealer simply shifted the trading zone. So those people going short here, they will be surprised by the spike candle. So I've told you that on Monday to Tuesday, if the stop hunt is not, if there's news release on Monday going Tuesday before New York, we usually anticipate for a stop hunt if there is news release. So this is an example here. So if you are on the market at this time, you would have gone wrong for this trade. And this was Friday here. So if you are in the market 5 minutes before the news release, you enter long at this area. Okay?
Okay.
We have the code of wood. Code of wood looks like this. Basically two railroad tracks. This is an example of a code of wood happened on euro
Okay.
pound. This is also a reversal pattern where the dealer uses it to reverse. We have the high test and the low test pattern. The high test and the low test pattern usually occurs at the price of yesterday's high or the price of yesterday's low. The dealer comes to yesterday's high or yesterday's low. We have the blue tracer here. So this blue tracer here marks yesterday's low. This one marks yesterday's high.
Okay.
So the dealer comes to yesterday's low here. He does a low test. Simply pins the low or pins the high without closing a candle below it. You see the pins here. And then
Yes.
you wait for the entry confirmation. So this one here was the entry. The dealer closed the candle above 5 and 13, and this was the low test. Sometimes he might come back for a second leg here, and simply he would test the low and then swing high. Okay.
Okay.
So this is the low test pattern, and we also have the high test pattern. So if it happens to the yesterday's high, simply high test pattern. Today found one low test pattern, euro pound. You see euro pound here. It went all the way to yesterday's
Yes.
low. See here, gap time. During gap time, after the end of gap time, simply he did the low test pattern 12. And then he had a shift candle. So this one is called a shift candle. It has, sometimes it has 10 plus pips. It's also one of the spike candles that occurs on the V or a V top or a V bottom. It's called a shift candle. And if it happens, you enter aggressively here.
How do you discern if it's a shift candle or a change candle, or a shift candle or a spike candle?
Well, a shift candle happens when there is no news release.
Okay.
So the spikes usually happens during news release.
Okay.
So important thing is to understand that the candlestick pattern can only be defined at the close of a candle. So you wait for the candle to close in order to define that candlestick pattern. If you are impatient, you find that the candle may be a railroad track. So if you are impatient enough, if you're impatient, can you hear me, Amy?
I think I lost you.
Can you hear me now?
Can you hear me?
Yeah, I can hear you. Wow. What's the name? No, don't say that. Hello, Amy.
Now I can hear. Yeah, now I can hear you.
Okay, let's continue. The most important thing to understand in the candlestick pattern is that the pattern can only be defined at a close of a candle. So you need to be patient to wait for the candle to close on the 15th minute. There is a certain behavior where you find the candle showing its true identity in the last part of the candlestick period. In the last part of the candlestick period.
Okay.
So you find the candle maybe is green, and the last part of the candlestick period is simply a doji, which is red. So you wait for the candlestick to close in order to avoid the backside of the hour. Okay, let's continue now with the indicators. Let's start with the exponential moving average. So the EMAs, when used in an appropriate way and control, they can give a true reading of market direction, a reading of market momentum. You can have the entries, you can have the exit points, and the exit point, those are the targets for our take profits. And usually the moving average, the exponential moving average, are used as support and resistance points. So the moving average that we have, specifically, we have a moving average with a period of 5, the yellow one. The yellow one is usually in here.
Okay.
Okay. We have the red one. The yellow, we call it the mustard. The red, we call it ketchup. The 50 is light blue. We call it water. The 200 is white. It's the mayonnaise. And the 800 is the dark blue. It's the blueberry. So Steve defined the EMAs using the, don't know, his favorite foods, using the colors and the foods.
I know all the colors. I can pick those out. Dana taught me that a little while ago. I don't know what the numbers mean that correlate with them, though.
Use them. First of all, you should know that going up in time frames, we divide the moving average by 4. Like if you have a 200 EMA on the 15 minutes, going to the hour 1 time frame, you divide the 200 to 4 is the 50 EMA. So you can see that the 200 is the 50 in hour 1, is the 13 in hour 4. The 800 in the 15 minutes is the 200 in the hour 1, is the 15 in hour 4, and in the day is the 13 EMA. So it goes like that. And going down in time frame, you multiply by 4. So going this way is the reverse direction. So one of the uses of the MR crosses, this is in hour 1 time frame. We're talking about the hour 1 time frame now.
Okay.
If you see a 13 and 50 cross on the hour 1 time frame, that's a level 1 block. After a peak is formed and you find out the 13 and 50 have crossed, that's the level 1 lock. That's the level 1 is now completed, and we say that the peak is locked. We expect 2 more levels down. If a peak is locked, we expect 2 more levels down. And if you see a 50 and 200 cross on the hour 1, there is the level 2 confirmation that the dealer now is a level 2.
Okay.
So the 13 and 50 cross in the 15 minutes is the 50 and 200 cross. So I would talk of a peak look as a 50 and 200 cross in the 15 minutes chart, right?
Yes.
So uses of the EMAs, the 5 and 13 crossover is a signal line on the M's and W's. So when an M is formed, the second leg M should be above, the second leg M should be below the 5 and 13 EMA, and the 5 and 13 EMA should have a crossover. When an M is formed, Amy, are you here?
Okay.
Do you hear me?
Yes.
No, I got it. Fine. I got to come to better.
Can you hear me, Amy?
Yeah, the one idea is still going to say it. That's still